Welcome back to Factful Finance, where we make sense of the numbers that matter. Here's a thought to kick things off. Did you know that in the world of investing, your brain can sometimes be your worst enemy? Crazy, right? But it's true. Many investors unknowingly sabotage their own portfolios because of psychological traps. So let's dive into the fascinating realm of behavioral finance and see how we can outsmart those mental biases and invest smarter. Before we go further, just a quick disclaimer. This video is for educational purposes only. We're not endorsing any particular product or app, and we always recommend consulting a professional for personalized advice. Now, you've probably heard about the technical side of investing, things like asset allocation, diversification, and market trends. But what about the psychology behind your decisions? It turns out that understanding your brain can be just as important as understanding stocks and bonds. Behavioral finance is all about how psychological factors influence financial decisions. It challenges the traditional notion that people always act rationally in markets. In fact, we often don't. We make emotional, impulsive decisions based on biases and faulty thinking. And when it comes to investing, these mental traps can cost us dearly. Let's take a closer look at a few of these biases and how to avoid them. First up, loss aversion. This is the tendency to fear losses more than we value gains. Studies have shown that people feel the pain of a loss about twice as strongly as the joy of a gain. For example, imagine you're holding onto a stock that's been plummeting for months. You're reluctant to sell it because doing so would mean accepting the loss. But hanging on might keep you from capitalizing on other opportunities. The key here is to stick to a clear strategy, focusing on the long-term goals rather than short-term fluctuations. Then there's confirmation bias, our natural instinct to seek out information that supports what we already believe, while ignoring contradictory facts. Let's say you're invested in a particular stock, and you're searching for news articles or analysts who say it's a great buy. This bias can lead you to ignore warning signs, which is a dangerous game in investing. Instead, make sure you seek out diverse opinions and always challenge your own assumptions. Next, let's talk about overconfidence. It's easy to fall into the trap of thinking we know more than we do, especially when we've had some success in the markets. This can lead to risky investments, excessive trading, or underestimating potential losses. Remember, even seasoned investors can't predict the market perfectly, so it's important to stay humble and be prepared for the unexpected. Another biggie is herding behavior. When we follow the crowd, assuming everyone else must know something we don't. Think about the dot-com bubble or the 2008 financial crisis. People were rushing to make similar investments, believing it was the right move simply because everyone else was doing it. The lesson here is to trust your research, not the crowd, and avoid making decisions out of fear of missing out. Now you may be wondering, how do I avoid these psychological traps and make better investment decisions? Great question. First, set clear investment goals. Know your risk tolerance, your time horizon, and your financial objectives. This will help you stay on track and avoid getting swayed by market noise or emotions. Second, diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different asset classes to reduce risk and avoid making decisions based solely on the performance of a single investment. Third, develop a disciplined strategy and stick to it. This means avoiding emotional decisions like buying based on hype or selling because of fear. A well-thought-out plan will help you stay focused on your long-term goals, even when the market gets turbulent. And finally, review your portfolio regularly. Make sure your investments still align with your goals. Behavioral finance tells us that we're often biased toward our past decisions, so it's essential to periodically reassess and adjust your strategy. Here's a real-world example. Meet William. He's a 40-year-old professional with a decent savings account. He's thinking of investing in a hot tech stock that's been all the rage lately. Instead of diving in headfirst, he takes a step back and asks himself, does this fit with my long-term plan? After evaluating his options and diversifying his investments, he's able to avoid the pitfall of following the crowd and ends up making a more balanced, thoughtful decision. Behavioral finance can have a massive impact on your investing success, By understanding the biases that shape our financial decisions, you can gain an edge and avoid costly mistakes. So, what's the first step you'll take toward making more rational investment decisions? Drop your thoughts in the comments below. Thank you so much for joining us on this journey to financial wisdom. If you enjoyed this video, why not hit the subscribe button so you don't miss out on more tips to help you achieve your financial goals. And we think you'll find the video on the screen next particularly useful. It might just be the boost you need to level up your financial strategy. Until next time, stay financially savvy and keep investing with confidence.